Welcome back, everyone. Michael here with Offshore Citizen. Today I'm going to discuss a little bit about the perspective of corporate enterprises redirecting their capital and the bull case for Ethereum or Ethereum-alike projects relative to Bitcoin, etc. Now, noteworthy is this is not a very short time frame video. What do I mean by this? What I mean is I'm certainly not saying that, hey, in the next week or 2 weeks or month or 3 months even, that this is relevant, okay? This is more like the macro. If you're gonna have a buy and hold perspective on an asset, what might be worth considering in regards to where money is going to flow over time and how that means for people who want to do a set and forget type investment, there may be a positive uptick. And hopefully the thought process or logic that I will discuss here will be useful to you. Now, I'd love to hear yours. I would love to hear, tell me in the comments below what you think about Ethereum, what you think about Bitcoin, what you think about general flows of capital over time in the world in general, and what types of assets you think are good for holding long term. I would love to hear you on that. So before we do it, if you haven't already, please hit the subscribe button. I really appreciate your support. Please share the video with your friends. Please share the channel with your friends. I really appreciate trying to help us grow. Aside from that, if you would like help with the topics that we deal with here, which are mainly about international, where to move, international tax optimization, how to pay the lowest legal amount of tax possible, forming companies, opening bank accounts, getting residencies and citizenships around the world, please reach out to me. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below, or send a message to our websites, offshorecitizen.net and offshorecapitalist.com. Let's dive in. So very quickly, for those who do not know what Ethereum is the second largest by market cap cryptocurrency after Bitcoin. It was kind of created with the idea of being sort of a global operating system computer on which you can run other programs. So in this sense, Bitcoin is basically just like a digital piece of property, an asset, and it doesn't really do that much aside from transferring value, right? Basically, the purpose of Bitcoin is essentially to store and transfer value. Whereas when it comes to Ethereum, it is programmable, so you can do a lot more things with it. It would kind of really popularize the idea of smart contracts. And so although Ethereum itself is about half the market cap of Bitcoin, maybe depending on the day, slightly less, slightly more, whatever, around that, the assets built and stored on the Ethereum blockchain would equal a lot extra. I don't know what the numbers would be officially, but I would guess that it probably puts it up. It's possibly larger than Bitcoin as a network in that regard. Most of the NFTs are built on Ethereum. Most of the major projects you're going to see, etc., are built on Ethereum if they aren't kind of their own layer one blockchain. So yeah, it's very, very significant in the world. It was created by Vitalik. I believe they launched it initially in 2015, something like that. And yeah, it's done really well. It is plagued by high transaction costs and relatively slow transaction speeds, but otherwise it is certainly a massive success in many regards. Now, here's the thing that I've been thinking about lately, which is, okay, what are assets going to do over time? What is going to do well? How will Bitcoin do? Where are we at in the cycle? Et cetera, et cetera. And Ethereum is going through a really major change right now, which is they're moving from the original Ethereum to Ethereum 2.0. Technically, some people might argue Ethereum Classic was the original Ethereum. We'll leave that conversation out of it for now. Ethereum 2.0 is a migration from a proof of work model, which is based on the Nakamoto consensus found in Bitcoin, to proof of stake. And they have a particular type of proof of stake that they are using with Ethereum. I've done some videos on proof of work versus proof of stake. We can have that whole debate, etc. But the bottom line is that instead of requiring to burn electricity in order to make the network secure, what you have is you have to put up or stake synthetic assets, in this case, ETH, the tokens, okay? Now, that's going to be really important in a second, and so I'm going to get into it, but I want you to understand that going in, okay? Now, in addition to this, Ethereum 2.0 is supposed to be faster, it's supposed to have a lot more throughput, they're introducing the possibility of sharding, et cetera, et cetera. complex technical discussion we don't need to have here. But just be aware of this change. And the most significant one is move from proof of work to proof of stake, because that's very important for this. The other thing that I'm going to talk about shortly is what's called EIP 1559, which was a change to the Ethereum network that happened fairly recently, and how that's going to affect you. Okay, so all of that stuff is the context. Now, let's recognize what has been happening over the last about 2 years. And this is that companies have started to buy Bitcoin. Okay, now, I've talked in some previous videos about why this is actually a sensible thing for them to do. If you think about it from the standpoint of wealth preservation, you have money in your company, right? Let's say you're, Apple, and you're holding whatever, $200 billion of cash, or whatever that crazy number is. Inflation is eroding the value of that cash. And so you say, well, hang on a minute. I don't want that. I need to do something with the money. Now, of course, they're buying back shares and distributing dividends. So there's something that they can do. But beyond that, they can think to themselves, okay, well, for the purpose of wealth preservation and purchasing power preservation, so that we have the same value going forward that we've already accrued through our profitable business, we want to protect ourselves from two forces, which are inflation and deflation, right? Currency is pretty good for, or government treasuries, T-bills, would be really good for most companies. And traditionally, they worked actually for both sides, which I'll talk about in a second. But in particular, they work in a deflationary environment, right? In a deflationary environment, the value of assets goes down, which means the relative value of cash goes up. Now, historically, there was also an interest rate paid, and you could maybe get 5% on that. And this was enough to counterbalance the effects of inflation, right? So it was fairly reasonable for a company to hold a lot of T-bills. Nowadays, interest rates are lower and inflation is higher. So the erosion of purchasing power is fairly substantial. The numbers just came back in the US. For November, it was 6.8% year over year. So, 6.8% inflation, far above what you're going to be getting in interest rates. And so you have purchasing power eroding. Because of this, the companies have to think to themselves, okay, well, what can I put my money into instead that will provide me with some inflation hedge? You could buy gold, you could buy real estate, things like this. But one of the things that they've kind of settled on as being a great asset, partly led by MicroStrategy, Tesla's, the other really famous adopter, but there's Square and some others as well, is Bitcoin. The idea being Bitcoin has a finite supply, and therefore as the supply of money increases, the price of Bitcoin will go up. I've mentioned in some previous videos about how there's kind of this accretive effect, and kind of explained how that works. You can go back and check those out. The bottom line is that there's a narrative that Bitcoin is a good hedge against inflation. Is it? We don't know. At this point in time, it's way too early. Certainly, there's no correlation between inflation and the price of Bitcoin. So we'll see. We'll see what happens. But the theory is there. And you can make it really efficient as a capital allocation thing because, so first of all, it's highly liquid. You can pretty easily get in and out. It's pretty easy to transport, to store, etc. So it doesn't have a lot of the problems that, say, physical gold or whatever else has. At the same time, it's also been proven to be really safe and solid. People can store and transfer billions of dollars really easily with it, and that's an attractive property. As well as you're in a situation where the volatility is sufficiently high that if you apply something called risk parity, which risk parity is basically the idea of balancing what you have in different baskets, not based on the raw percentages of your portfolio, but rather based on the volatility in each basket. You can have a relatively small amount of Bitcoin relative to the larger amount of bonds in order to make this balance work. Okay, so maybe like a 20x volatility increase between Bitcoin and bonds, which means there's a 5-to-1 ratio, or sorry, a 20-to-1 ratio. So about 95-5-ish ratio for some company that wants to hold a share of their treasury in Bitcoin. Okay, so that's some background information for you. Now, here's the thing. The interesting point here is there's been a narrative for quite a long time that gold is the store of value, that gold is the inflation hedge, etc. In practice, gold hasn't been a very good store of value. We've seen, prices have done pretty poorly over the last 10 years or so. And there's arguments against it long term. Now, of course, some people are long-term gold bugs and, they believe their narrative, etc. Maybe it will be true. Certainly, if you own a piece of gold, you own that gold. And certainly, there's basically not going to be more gold made, and there's definitely a jewelry and industrial use. So gold will have value over time. It's not like somebody can make your gold worthless. Okay, they can take your gold away. It can be confiscated. That's a whole other conversation. But there's this. However, a lot of the demand for gold comes from people just holding it as a store of value or investment. And so you can debate, well, if Bitcoin is a better store of value, then over time will that pull value from gold? Now, I actually think that this mislabels the conversation, because the real store of value that has really been used on large scale has not been gold. It has been government securities, specifically US treasuries. Sometimes TIPS, which is Treasury Inflation Protected Securities, something like that. So they have some inflation hedging built into them. Now, if you look at any major company, what are they doing to store value? Government securities. That's what it has been. And I think that actually the real competitor that Bitcoin has is not gold, it is these securities. So that's quite interesting, because it's a lot larger volume of money. The market cap of gold is about $10 trillion. If I recall correctly, the bond market is about $300 trillion, something like that. So there's a lot more money out there in bonds. Now, granted, there's all kinds of grades of bonds in different countries and all this, but there's a lot more money that could flow somewhere. Now, if you think about it from that standpoint, we now enter the conversation that I was setting all this stuff up for, which is Ethereum. And so, or any other potential proof of stake, we'll call it a layer one, okay? Because there's a lot of cases where projects use staking and it's not proof of stake. There isn't a consensus algorithm which relies on using stake of the synthetic asset in order to secure the network. Okay, so why is this important? It's important because if you think about it from the standpoint of someone holding a treasury, like a corporate treasury, and they want to allocate this money, they think, okay, well, I could put my money in Bitcoin, but I could put it in anything, really, right? Like I said, you could put it in gold, you could put it in real estate, you could put it in whatever. Now, it helps if it's highly liquid. It helps if it is easy to store, cheap to store, easy to transfer, non-confiscatable, etc., right? Things like this. Now, it happens that in a lot of regards, Ethereum meets those same properties that Bitcoin does. Okay, all right, fair enough. However, there are some added pieces here, which is as Ethereum goes from proof of work to proof of stake, now you can actually get paid for holding Ethereum. So at the moment, people who have converted their ETH to ETH2 have been able to stake it, and they're earning, I think the rates now are around 12% a year, which is pretty good, right? Pretty good in terms of the amount of Ethereum that you're getting paid as basically interest for staking it and helping to secure the network. Now at the moment, because there's a transition phase between Ethereum 1 and Ethereum 2, that's locked up and it's illiquid. So companies are not going to put their money into there right now because they may have liquidity needs. So if they take their treasury and they put it there and it's an undefined period of time, we don't know how long until they work out all the kinks of ETH2 and manage to roll it out such that people can gain access to it. Maybe it's 6 months, maybe it's a year, maybe it's 2 years, right? Could be a long time. That doesn't work for companies. But over time, if you think about it, if I'm going to hold a synthetic asset and I have a choice between Bitcoin and we're going to use Ethereum in this example, technically speaking, it could be any other L1 proof of stake where I could stake it and get money. If I can get paid on this one and I don't get paid on this one, which of these two is more attractive? This one, of course. Absolutely, like I'm holding it, I'm getting paid. So why wouldn't I hold it then, right? So first of all, as I said, there was this liquidity problem at the moment. Number two, Bitcoin has definitely done a better job of making itself a durable, resistant, trustworthy network. It's done an exceptionally good job of that. Okay, it's never been hacked. It's like very much protected by the Bitcoin core community. It's a quite decentralized group of node operators and miners. They're spread out all over the place. There's many of them. So it's very resilient in a lot of different regards. And it's managed to go through a lot of different events without shaking that foundation. This is very, very solid for Bitcoin. It's also, larger by market cap. It's also more liquid as a result, etc. So there's lots of reasons to believe Bitcoin is a great thing to hold. But is that a temporary status or a long-term status? So right now there's a dependency, for example, on a provider called Infura, who are one of the main operators for the Ethereum network. And there's way too much dependence on Infura. Now, fortunately, the community is aware of this, and there's some work to try and get off of that side of things. And if they do, that will help, right? If they can diversify a lot more in terms of the providers. This being said, right now it's a reason why corporate treasuries will not allocate to Ethereum. Next, you're in a situation where there has been more history of change, and in general, the protocol hasn't been trusted as much not to change. So that's, again, a weakness in terms of that reliability. Third, historically, whereas Bitcoin has a capped supply, Ethereum does not. And so in theory, Ethereum has had a more inflationary mechanism than Bitcoin has. Bitcoin is technically disinflationary, meaning the rate of inflation is declining towards that hard cap on the number of tokens. There's reasons, and I've done videos on this before as well, for believing that actually this is a security vulnerability long term and will have to be something they'll deal with. We'll see what happens, but that's a possible concern. However, Ethereum recently introduced this summer the change which is called EIP 1559, and one of the things they brought into that was actually a deflationary mechanism. So suddenly, for the first time, whereas Bitcoin is disinflationary, Ethereum can be actually truly deflationary. And so there's a strong reason to believe that this has more upward price mechanics built into it and could function more effectively as a store of value and an inflation hedge than Bitcoin could. So long term, that's pretty attractive. That's pretty interesting, right? So do they have some issues to work through? Yeah, they do. But on the other hand, if you kind of take a longer time horizon view, let's say you look out 5 years, what is the chance that a lot of corporations start storing a large amount of money in Ethereum? Could be high, right? Could be high. Now, it's worth noting there's a lot of competitors to Ethereum. There's a lot of kind of like ETH killers, as they say. You've got Solana, Avalanche, Near. I did the interview with Marco back a little while ago where I covered a bunch of them. There's many more than the ones that I covered, but there's a lot of other protocols out there competing. And certainly when I look at it from a technology standpoint, I'm not that bullish on ETH2. It seems to me that the best case scenario for ETH2 is not that attractive relative to some of the other options that are already out there and already developed. On the other hand, Ethereum has the network effects, it has the developer community, it has a lot of projects already built on it, so maybe that's enough to carry it forward. Some people argue that layer 2 scaling solutions, optimistic rollups, Arbitrum, ZK rollups, etc., will be things that will allow them to scale really effectively, and so you won't need to worry about this. We'll see. We'll see exactly how that plays out. But I think the interesting argument here is simply that over time, again, looking at these two major assets, where is the money likely to flow? I think that if you can have enough liquidity, you can build enough trust in the underlying stability of the protocol and safety of the money, etc., that this is a much more attractive asset. That is to say, Ethereum under ETH2 versus Bitcoin. And what this would imply to me is that over time, more long-term held capital will flow into Ethereum versus Bitcoin. Now, that assumes that we don't have these issues with, as I mentioned, somebody coming along and disrupting it from a technology standpoint, which is, it's arguably more likely that Ethereum will get disrupted than that Bitcoin will get disrupted. I actually think there's a good chance both of them could get disrupted. But it's an interesting long-term case for the likelihood that more capital will go there, and consequently the market cap will rise. So anyway, curious to hear what you guys think. I don't know, it's not necessarily something where at any given price point it makes sense to acquire, but I do think as a long-term asset, it's a reasonable idea to allocate some portion of capital if you're looking for something that's kind of set and forget, in particular if you can stake, and like I said, you can earn 12%-ish, just having it sit there, well, that's better than you're getting in the bank. And over a long period of time, is the price likely to be stable? We'll see. We'll see. Obviously, we're high in a bull market right now, so I'm not personally acquiring at these prices, but I think the narrative is important. And so I think in general, this frame of mind of thinking like, okay, where do the economic incentives mean capital is going to flow is a useful way of looking at the world. And so I'm curious to hear what you guys think in terms of what do you see as the incentives driving capital in one direction or another. So I hope that helps. Curious to hear what you have to say, and I'm going to see you on the next video.